This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to the Roundup. We are diving into the biggest shifts in global finance, social media business, and the cutting edge of artificial intelligence that is currently reshaping our world.
TikTok star Khaby Lame's massive stock deal faces major trading blocks.
Supermarkets may soon adopt dynamic surge pricing for essential groceries.
Global markets wobble as Middle East ceasefire stability remains uncertain.
Anthropic withholds a powerful AI model due to hacking risks.
Stocks surged briefly following the initial U.S.-Iran ceasefire announcement.
American job seekers report the lowest confidence since the pandemic.
OpenBuilder raises millions to disrupt the vibe coding pricing model.
Oil prices climb again as investors doubt the regional truce.
First, the TikTok mystery.
Khaby Lame, the world's most followed TikToker, is finding that the transition from viral videos to Wall Street is incredibly complicated. Back in January, he announced a massive $975 million deal to merge his business with a financial printing firm called Rich Sparkle Holdings. The idea was to let his 160 million followers buy into his brand. However, the stock, trading under the ticker ANPA, has since plummeted over 90% from its peak. Major brokerages like Fidelity, Vanguard, and Charles Schwab have now restricted or outright blocked trading on the stock. They cite concerns about low market capitalization and the potential for logistical headaches if the company disappears. It is a classic example of the risks involved when influencer hype meets the rigid, often unforgiving world of microcap stock trading.
The silence from Lame's camp is what is really fueling the confusion right now. After the initial excitement, there have been no formal filings to prove the deal was actually finalized, or that Lame received the 75 million shares he was promised. Even more telling is that Khaby has scrubbed the stock ticker from his social media bios. While platforms like Robinhood still allow trading, the heavyweights of the investment world are signaling that this might not be a safe bet for retail investors. Finance experts point out that brokers often do their customers a favor by blocking these volatile stocks before they vanish entirely. It is a stark reminder that even the biggest digital audience in the world cannot bypass the fundamental requirements of corporate transparency and market stability when trying to launch a public company.
Next, grocery price shifts.
The Bank of England is warning that the era of fixed prices at the supermarket might be coming to an end. We are talking about dynamic pricing, or surge pricing, which is already common for Uber rides and flight tickets. Now, supermarkets are installing digital shelf labels that allow them to change the cost of milk or bread in an instant based on demand. The Deputy Governor for Monetary Policy, Claire Lombardelli, noted that digitalization has slashed the cost of changing prices, which economists call menu costs. In the past, stores had to manually print and swap out paper tags, but now it can be done with a single click. 1 in 3 companies are already planning to use these market-responsive tools, up significantly from just a year ago, signaling a massive shift in how we shop.
This move is likely to be incredibly controversial because food is an essential item, unlike a concert ticket or a luxury ride. While defenders of the system argue that prices could also drop during low-demand periods to help those on a budget, the fear is that consumers will be hit with higher costs during peak evening hours when they have no choice but to shop. Retailers like Morrison's are already rolling out these digital displays across hundreds of stores. While they claim it is for efficiency, the infrastructure for real-time price hikes is officially in place. MPs and consumer advocacy groups are expected to push back hard, as this could fundamentally change the cost of living. If you thought grocery shopping was stressful before, imagine checking the price of eggs only to see it rise while you are walking to the checkout.
Now, the global markets.
Global markets are currently on edge as the ceasefire deal between the U.S. and Iran shows signs of extreme fragility. This morning, oil prices began to climb again, with Brent crude rising over 2% to nearly $97 a barrel. This follows a massive 10% drop just yesterday when news of the truce first broke. The volatility stems from reports that the ceasefire is already being tested. Both the UAE and Kuwait reported intercepting drones, while Iranian officials claimed the agreement had been violated multiple times. Asian markets reacted sharply to this uncertainty, with Japan's Nikkei and South Korea's Kospi seeing significant losses. These countries are particularly sensitive to Middle Eastern stability because they rely so heavily on the region for their energy supplies, making any hint of renewed conflict a major economic threat.
Adding to the market jitters are recent social media posts from Donald Trump, who stated that U.S. forces will remain in and around Iran until a real agreement is fully complied with. He even suggested that military action could be stronger than anything seen before, if the terms are not met. This aggressive rhetoric, combined with his criticisms of NATO and mentions of Greenland, has investors worried about a return to the unpredictable trade and tariff threats of the past. Strategists at Deutsche Bank are noting that the 2-week truce is far from a permanent solution. With the Strait of Hormuz seeing halted tanker traffic due to ongoing strikes in Lebanon, the global supply chain remains at risk. Investors are moving into a risk-off mode, favoring safety over growth, as they wait to see if this diplomatic window actually leads to a lasting peace.
Next, Anthropic's safety move.
Anthropic has made a bold move by announcing they will not release their latest AI model, Claude Mythos, to the general public. The reason is quite startling. The model is so good at coding that it can find and exploit software vulnerabilities that have gone unnoticed for decades. In testing, Mythos uncovered flaws in widely used applications that had been tested millions of times by their own creators. Some of these security holes dated back 27 years. Anthropic's leadership, including Mike Krieger, explained at a recent conference that the risk of this tool being used for widespread hacking is simply too high. They believe AI has reached a threshold where it can now surpass almost all human experts in identifying exploitable code, which poses a severe threat to national security and the global economy if it falls into the wrong hands.
Instead of a public launch, Anthropic is forming a defensive alliance called Project Glasswing. They are sharing Mythos with cybersecurity giants like CrowdStrike and Palo Alto Networks, as well as tech titans like Microsoft, Apple, and Amazon. The goal is to give the good guys a head start, allowing them to use the AI to find and patch vulnerabilities before malicious actors can develop similar tools. This collaborative approach includes networking leaders like Cisco and the Linux Foundation, emphasizing that the threat is too large for any one company to handle alone. It marks a significant shift in the AI arms race, where the focus is moving from pure capability to responsible containment. By arming the open-source community and security specialists first, Anthropic hopes to bolster global digital defenses before the next generation of autonomous hacking tools inevitably arrives.
Moving to the ceasefire.
Before the recent wobbles, we saw a massive relief rally across global stock exchanges following the announcement of the 2-week US-Iran ceasefire. In London, the FTSE 100 soared by 2.5%, while markets in Paris and Frankfurt saw even bigger jumps of over 4 and 5%. This risk-on move was driven by the temporary reopening of the Strait of Hormuz, which caused oil prices to tumble from $110 down to around $95 a barrel. For a moment, investors felt a sense of profound relief that a full-scale regional war might be avoided. Both Washington and Tehran claimed victory in the conflict, with President Trump calling it a total win. This surge in equity prices reflected a market that was desperate for any sign of de-escalation in a very tense geopolitical climate.
However, market analysts are already warning that this rally might be short-lived. While the 2-week window provides some breathing room, it is not a final resolution. Tehran has expressed complete distrust heading into upcoming talks in Pakistan, and the underlying tensions remain unresolved. Analysts at Trade Nation pointed out that the sustainability of these gains depends entirely on whether shipping through the Strait of Hormuz can truly return to pre-war normality. If the ceasefire holds and formal terms are negotiated, we could see a more permanent recovery. But for now, the market is essentially trading on time. Time is the most valuable currency right now, and until there is evidence of a long-term deal, many investors are staying cautious. The initial euphoria is already being replaced by a sober realization of how complex the path to peace actually is.
Next, the job market.
The mood among American job seekers has turned decidedly grim. New data from the Federal Reserve Bank of New York shows that workers now rate their chances of finding a new job within 3 months at just 45%. That is a lower level of confidence than we saw during the height of the pandemic in 2002. It is a massive shift from the optimism of the Great Resignation era when jobs seemed to be everywhere. Today, the market feels much more like the slow, grinding recovery following the 2008 financial crisis. People are not just worried about finding new roles, They are also increasingly afraid of losing the jobs they currently have. This malaise is being compounded by high gas prices and stock market volatility, which are dragging down overall consumer sentiment across the country.
The statistics on long-term unemployment are particularly concerning. More than a quarter of jobless Americans have now been out of work for 27 weeks or more. The median time spent searching for a job has climbed to 11.5 weeks, which is nearly half a month longer than it was just a year ago. Some applicants report sending out thousands of resumes without success, describing a market that feels frozen despite low official unemployment numbers. There is a small silver lining, though, as March saw a surprising bounce back with 178,000 new jobs added to the economy. This growth was spread across multiple sectors, suggesting that while the search is harder and takes longer, the opportunities have not completely vanished. For now, though, the psychological toll on the American workforce is evident as the era of easy hiring ends.
Now, vibe coding news.
A new startup called OpenBuilder is taking aim at the giants of the vibe coding world, like Replit and Louvable. Vibe coding is the trend where non-technical users use AI to build software just by describing what they want. OpenBuilder recently raised $2.2 million in seed funding with a very specific pitch. The current pricing models in the industry are broken. Most competitors use credit-based systems that actually profit when a user gets stuck or encounters a bug, because the user has to keep spending credits to fix the errors. OpenBuilder's CEO Paul Lee argues that this is unsustainable. Instead, they are offering a fixed subscription for unlimited use, combined with the option to pay for actual human developer support when the AI hits a wall. It is a bet that users will eventually demand more transparent costs.
The company is leveraging cheaper, open-source AI models from startups like DeepSeek to keep their own costs down. Lee believes that as the cost of AI intelligence inevitably falls, the pay-per-use models used by the big players will become obsolete. OpenBuilder is specifically targeting small business owners and hobbyists who want to build custom tools without paying for expensive enterprise software. Interestingly, the founders are repeat Y Combinator participants who previously built a successful coding assistant with over 1 million installs. They are using their new capital to hire more staff and ramp up marketing. By focusing on the non-technical builder and providing a safety net of human experts, they hope to solve the frustration of unfinished projects that often plagues the vibe coding experience. It is a fascinating look at how the business of AI development is maturing.
Finally, oil's return climb.
The relief we saw in the markets yesterday is quickly evaporating as oil prices surge back toward the $100 mark. Brent crude jumped 3.5% this morning as reality sets in regarding the Middle East. While the ceasefire was a welcome headline, the actual situation on the ground remains volatile. Iran reportedly closed the Strait of Hormuz again last night in response to continued Israeli strikes on Hezbollah in Lebanon. This choke point is vital for global energy, and any obstruction there immediately sends shockwaves through the economy. European markets opened in the red today, with Germany's DAX falling by 1%. It seems the market is struggling to turn yesterday's relief into actual belief that the conflict is over. The threat of Iran withdrawing from the truce remains a very real possibility if hostilities continue.
Analysts are pointing out that even if shipments through the strait resume, the risks are not going away. Tankers will likely have to navigate waters that may be mined, all while under a heavy military presence. This means insurance premiums and freight costs will stay elevated for the foreseeable future, keeping inflation pressure high. The White House has maintained an aggressive stance, keeping forces poised to act, which adds another layer of tension. Experts from the Wealth Club noted that achieving a long-lasting deal in this region is incredibly complex, and a 2-week window might just be a pause rather than a solution. As long as oil stays near $98, it signals that investors are still pricing in a significant risk of disruption. The next few days of negotiations will be critical for determining if global markets can find a stable floor.
That is our roundup for today. Follow us for the next daily briefing to stay ahead of the stories that matter most. We will see you back here tomorrow.